Hello and welcome back to Invest with King. Warren Buffett, widely regarded as one of the greatest investors of all time, has emphasized the importance of understanding market history and avoiding overconfidence. In a recent discussion, he highlighted two key lessons the new investors should consider before jumping into the stock market. His insights provide a cautionary tale about market cycles, the unpredictability of corporate dominance, and the importance of long-term investing. On March 1st, Buffett reviewed a list of the 20 largest companies in the world by stock market value. The list included many familiar names, with Apple at the top, valued at over $2 trillion. Among the top 6 companies, 5 were American, a testament to the strength of the U.S. economy. The remarkable dominance is particularly impressive given the country's humble beginnings. In 1790, the U.S. had only 4 million people, less than 0.5% of the world's population. Countries like Russia, Ukraine, and Ireland all had larger populations. Despite this, over the course of 232 years, the U.S. developed into a global economic powerhouse. This transformation wasn't due to the sheer intelligence or natural resources alone, but was driven by a system that encouraged innovation, free enterprise, and long-term growth. Buffett then proposed a thought-provoking question. How many of these companies will still be on the list 30 years from now? Investors might assume that these corporate giants are here to stay, but history tells a different story. To illustrate this, Buffett pulled up a list of top 20 largest companies from '89, just over 30 years ago. The most striking thing was none of the top 20 companies from '89 remained on the list in 2023. This revelation serves as a powerful reminder of how much the world can change in just a few decades. Back in '89, companies like General Electric, Exxon, IBM, and Merck dominated the market. While these firms are still in existence, none of them retain their position among the largest companies. Japan, which had experienced a massive economic boom in the '80s, had several companies on the list at that time. However, today, none of those Japanese firms remain among the top 20. What does this mean for investors today? It highlights the unpredictability of market leadership. Even companies that seem invincible today may not hold their position in the future. The rapid rise of new industries and the decline of old ones can completely reshape the biz landscape. Buffett emphasized that this unpredictability is why index funds are such a compelling investment strategy. Instead of trying to pick the next big winners, investors are better off owning a broad and diversified portfolio that benefits from overall market growth. Another observation Buffett made was the increase in market cap over the years. In 1989, the largest company in the world was worth $100 billion. Today, the largest company, Apple, is worth over $2 trillion. Even the 20th largest company today is worth more than 10 times what the 20th largest company was worth in 1989. This exponential growth highlights two key factors: the powers of capitalism and the effects of inflation. While inflation has played a role in increasing market values, it doesn't fully explain the immense growth seen in stock. Instead, it reflects how businesses have been able to create and capture massive value over time. However, Buffett also warned against assuming this kind of growth will continue indefinitely. Just because companies have increased their value by 20 or 30 times over 30 years does not mean that they will do the same over the next 30. Investors should remain humble and recognize that market cycles and competitive landscapes change. To further illustrate the difficulty of predicting market winners, Buffett pointed out to the early days of the auto industry. At the turn of the 20th century, automobiles were an exciting new tech that promised to transform the world. Recognizing this, thousands of entrepreneurs jumped into the auto business, believing it was the industry of the future. By 1911, there were at least 2,000 auto companies in the U.S. alone. However, as history shows, very few of those survive. By 2009, only 3 major U.S. automakers remained, 2 of which, GM and Chrysler, went bankrupt. Despite the clear long-term potential of the auto industry, most investors who bet on individual car companies ended up losing. Buffett pointed out that even companies outside the auto industry saw the potential and attempted to enter the market. For example, the Maytag company, known for making appliances, once produced automobiles. Many other firms tried their hands at making cars, believing that the industry's growth would guarantee success. However, only a handful of companies survived. This serves as a critical reminder and a critical lesson for modern investors that just because an industry has massive growth does not mean that every company within that industry will succeed. Today, we see similar trends in emerging industries like electric vehicles, AI, and clean energy. While these sectors are likely to experience significant growth, predicting which specific companies will come out on top remains difficult. Buffett's analysis of market history supports his long-standing belief in the power of long-term investing. Rather than trying to pick individual stocks, he advises most investors to buy a low-cost S&P 500 index fund. This ensures that they remain invested in the overall market without having to worry about individual performance. In fact, Buffett has publicly stated that after his death, 90% of the money he leaves his family will be invested in an S&P 500, with the remaining 10% in treasury bills. This simple strategy ensures that his family benefits from long-term market growth while avoiding the risks of stock picking. Buffett also emphasized that success in investing requires a genuine interest on the subject. Those who love studying business and financial markets will naturally develop an edge over those who simply chase profits. He shared an anecdote from his early investing days when he would spend countless hours reading Moody's transportation manuals. This passion for researching and understanding business is what led to his extraordinary success. Buffett also touched on broader issues such as tariffs and inflation. He noted that tariffs are essentially a form of taxation and can create economic distortions. When governments impose tariffs on goods, the costs are often passed down to consumers in the form of higher prices. This can contribute to inflationary pressure over time. Regarding inflation, Buffett stated that prices will continue to rise over the next 10, 20, and 30 years. Inflation is just part of the economic system, and while it can fluctuate, the overall trend of the cost of goods and services increase. This is why investing in productive assets like stocks is important for preserving and growing wealth over time. He has also acknowledged that political dynamics in Washington are complex and often require compromise. While political decisions can have short-term economic impacts, Buffett believes that the overall system of capitalism and free enterprise in the U.S. has been incredibly resilient over time. Despite political debates and economic challenges, the U.S. economy has consistently grown and created immense value for investors. Buffett's reflections offer high-value insight for both new and experienced investors. His analysis of the changing list of the world's largest companies serves as a reminder that nothing in the stock market is permanent. Companies that dominate today may not exist a few decades from now. His discussion of the auto industry underscores the dangers of assuming that investing in a high-growth sector guarantees success. While new industries present exciting opportunities, history has shown that most companies within these industries don't survive in the long term. Ultimately, Buffett's advice remains simple. Focus on long-term investing, diversify through index funds, and invest only in individual stocks if you have a deep understanding of the business. The stock market may seem like an easy game, but as history has shown, the future is always uncertain. Investors who remain patient, disciplined, and humble are the ones who will reap the greatest rewards over time.